Let's now turn to double taxation. Taxpayers which are corporations are subject to tax under Section 11 of the Code. Just like individual taxpayers, corporations must recognize their own gross income, take into account their own deductible expenditures, and arrive at a taxable income amount upon which the corporation pays tax at the rates described in Section 11. This tax liability is an obligation of the corporation, for which the shareholders generally have no personal liability. But it does nevertheless affect the shareholders inasmuch as that less wealth accumulates in the corporation than would otherwise accumulate in the absence of corporate tax. Once a corporation has computed its taxable income and paid its corporate tax, that income, less the tax, is accumulated in a balance sheet called earnings and profits. This is roughly the same figure as what accountants call retained earnings. In other words, the earnings of the corporation that have not yet been distributed are retained. This is important because once distributed, the double taxation of the corporate tax becomes clear. Section 301C of the Code describes what is sometimes called the ordering rules for corporate distributions. Pursuant to this law, whenever a corporation transfers property to a shareholder not in liquidation of the stock, then, first, that portion of the distribution which is a dividend shall be included in the shareholder's gross income. Second, after accounting for the portion considered to be a dividend, that portion of the distribution that is up to the stockholder's stock basis will be a tax-free return of capital. And third, any distribution in excess of the shareholder's stock basis will be considered a capital gain. For purposes of the first step of these ordering rules, a dividend is any distribution of property from earnings and profits. A corporation with no earnings and profits cannot, therefore, pay a dividend. It is only after the corporation recognizes taxable income and accumulates some earnings and profits that a dividend becomes possible. Once earnings and profits accumulate, all distributions are generally considered distributions from earnings and profits and therefore are considered dividends. Consider the example above of a corporation formed by an individual taxpayer contributing a building worth $1 million, but having an adjusted basis in the shareholder's hands of only $100,000. The shareholder recognized no gain by reason of the contribution, but rather took a $100,000 basis in the corporate stock received. The corporation also recognized no gain upon receiving the building, but rather took a $100,000 carryover basis from the shareholder. If the corporation were soon thereafter to sell the building for $1 million, it would recognize $900,000 in taxable gain. Assuming no deductions and assuming a 20% corporate tax, the corporation would pay $180,000 in federal tax and accumulate $720,000 in earnings and profits. Recall, however, that it sold the building for $1 million. So after paying the tax, the corporation should now have $820,000 in the bank. If it were to distribute this $820,000 to the shareholder, the first $720,000 would be considered a distribution from earnings and profits, and therefore a dividend includable in the shareholder's gross income. And the next $100,000 would be a tax-free return of the shareholder's capital. In other words, the same amount as his adjusted basis in the stock. Accordingly, although there was just $900,000 of gain built into the building before it was contributed to the corporation, after the building's sale and distribution of those sale proceeds to the shareholder, $900,000 has been recognized as taxable income to the corporation, and another $720,000 as taxable income to the shareholder. Not quite double, but considerably more gain than that which the shareholder started. The tax effect of redemptions and liquidations. The ordering rules of Section 301 apply to non-liquidating or operating distributions. That is, we're talking about distributions that do not necessarily affect the shareholder's stock. After such a distribution, the shareholder's stake in the corporation is unchanged. Thus, the distribution is considered a distribution of the corporation's earnings, or a dividend. Some distributions to shareholders, however, do affect the shareholder's stake in the business. The corporation might distribute property to a shareholder in exchange for some or all of his stock. That's a redemption. Or the corporation might dissolve completely and cease its existence. That's a liquidation. Although either one of these events is still a distribution, they cannot produce dividends to the shareholder, as neither of them is considered from earnings and profits. Nevertheless, the double taxation inherent in corporate taxation persists even in these events. When a distribution is considered a redemption, it's governed by Section 302 instead of 301. Instead of applying the ordering rules, the tax effect of a redemption is more straightforward. The distribution is simply deemed the consideration for the shareholder's stock. Thus, if a shareholder is paid $1 million in cash from a corporation in complete redemption of stock in which the shareholder has a $100,000 adjusted basis, the shareholder recognizes $900,000 in gain. Continuing with our example from above, in order for the corporation to make such a distribution of cash to the shareholder, it would have had to have sold the building first, in which case it would have recognized income on which a corporate tax also would have resulted. Again, double taxation. A similar result occurs in the case of a complete liquidation of the corporation. Under Section 336, a corporation recognizes gain when it distributes property in a complete liquidation, as if such property were sold to the distributee as its fair market value. Thus, any gain inherent in liquidating corporation's assets is first recognized by the corporation itself, triggering a corporate-level tax. Thereafter, under Section 331, shareholders are deemed to have sold their stock in a liquidation, with the liquidating proceeds deemed the consideration. Once again, double taxation. Thus, from the very beginning, by function of the concept of inside-outside basis parity, a corporation is set upon the path of double taxation whether it distributes profits to its shareholders, redeems its shareholders' stock, or completely liquidates. This nearly unavoidable doubling of the potential for tax can make a corporation an unattractive alternative for many taxpayers starting a new business. In other presentations, we will discuss similar business forms that can avoid this problem of double taxation.